Thank you all for joining us this evening. My name is Gregory Nicola. I'm here from the Equity Derivatives Desk at the JSE, and it's my pleasure to introduce Lavan, who is somewhat of a veteran of the markets, who will be talking on behalf of Trademark Futures about single stock futures. Single stock futures, in my opinion, is a very robust product. My boss often moans at me because we've recently launched a JSE CFD offering, and I'm still an advocate of the single stock future product. The way the product works is that when you trade it, the entire costs are seen up front, which means you have very good visibility of what your profits are over that period of time. With the eCFD, you've always got that interest rate that's been constantly taken from you over a daily basis, and for that reason, I prefer the single stock futures. The eCFDs and the single stock futures both have their places. They are both very good products, but the one thing I love about the single stock futures is that when you trade it, you know exactly what your cost is, and you pay it all up front, and the rest is pure market returns until you get to closeout. Another development I'd just like to make you aware of, if you'd like to go to our website, www.jse.co.za, we've got a link, so .co.za/SSF pricing, and if you go to that link, what it does is it shows you the spot market prices in the cash equities market, and it shows you the on-screen single stock futures prices, and it shows you the implied commission that is being charged by the market makers doing on-screen prices in the dividend neutral single stock futures. And recently we're quite happy that we have yet another market maker making markets on the single stock futures, and those commissions have gone down to below 10 basis points. And 10 basis points for us is the level at which we feel it's really a bargain, and you're going to do better on screen than you'll ever do through a report-only trade. So if you'd like to look at that, it's available all day. It's a live streaming feed. And basically what it says, if there's a 1 basis point spread in the spot market and there's a 4 basis point spread in the single stock futures market, it implies a 3 basis point commission for the single stock future market maker, which is very, very competitive. And for that reason, we're very excited about our on-screen single stock futures prices, and we hope to promote it and see it become even more liquid in the future. So without further ado, if I can introduce Lavan, who will be talking to you about single stock futures on large cap stocks.
Good evening, ladies and gentlemen. Welcome. Thank you very much for joining us this afternoon or this evening. So I know there's always traffic issues. You may find some of our other clients and guests streaming in, and I'm sure they'll be able to catch up. The presentation this evening is on large cap stocks specifically. And I chose this because I believe it's probably the best way to expose yourself to the futures market, to expose yourself to equity derivatives or single stock futures, as you often speak of it. And with large cap stocks, that's probably the best reflection of your trading abilities. It's liquid, it's easy to trade, and I'll tell you more about it as we get on. I know that you'll have many questions, and this evening we were supposed to have Ian Cruikshanks joining us, and he's given me an indication he can't make it this evening. So I'll be having probably a series of 8 or 10 lectures through the year, and we'll try and make sure that he joins us for one of the others. The topics are going to vary from commodity derivatives to equity derivatives and a number of trading strategies related to it. So I'm looking forward to seeing all of you, and the topics will be fresh. So it's not going to be just a repeat of the same futures explanation. So this evening we're going to be talking about specifically large cap stocks. I've said there it's your passport to trading South African breweries, MTN, Sasol. And what I've noticed over the last 20 years that I've been working as a stockbroker is the opportunities that are available within the derivatives market. And the full spectrum of product that exists means that there is sometimes an overload of information. The reality is, if you're trading, you can probably only track a few instruments at once. I was speaking to one of our friends earlier today, and we were talking about watching stop losses. And so I mentioned that I personally probably have 3 or 4 stocks that I'm watching, stop losses as well as price action. And if you start watching too many, you tend to lose focus. With respect to the large cap stocks, it gives you a fairly wide representation of the JSE, of the various sectors that make up the exchange, and of course the full scope of the South African economy. And I'll show you just some of them in a few moments. So what is a large cap stock? So we're talking about companies listed on the JSE. Generally, brokers will refer to the top 40 shares, and the top 40 shares is those companies that have got the largest market capitalization, that fit into certain rules that the JSE have decided on, and that are weighted in a certain fraction, and they make up the top 40 index. So it's 40 of the most popular shares. There are some companies, certainly international companies, that are excluded, and the JSE have got a set of rules that guide the inclusion. So in general, the top 40 shares make up most of the value of the market. And it's important to understand that it's not just their net worth that's valuable. It's the fact that on a daily basis, the transaction activity, which may be in the order of 12 billion per day. Yesterday, for example, we had a phenomenal day, 20 billion moved through the exchange. So let's say we're talking about 12 billion rands worth of transaction activity on any given day. About 90% of that is only 20 or 30 stocks. So from my point of view as your broker, from your point of view as the investor or speculator, you want to concentrate on that pool of stocks. Put differently, the market action is such that it herds you towards that. Yes, there's going to be rich rewards across the exchange, and there are a variety of different companies that will attract players that have done specific research. But from a trading point of view, and you'll understand how vital this is within the lens of single stock futures, it is a trading instrument. By its very nature, it means you want to be in and out in a very short space of time. Your time horizon should be maybe a week at the most. You will be fortunate if you can get a day trade working in your favor. You can exit, so you'll have a peaceful evening's sleep. But maybe you take on the trade for a few more days, maybe a week. You don't want to expand further than that. It's then becomes an issue in terms of the cost factor. You'll recall at the introduction there was a discussion about some of the interest rates that are applied to derivative instruments, and for that reason it starts then becoming an expensive exercise. So as I've mentioned, these account for most of the value on the exchange. They're very liquid, and so you can buy and sell them very quickly, very easily, and in large volumes if you require that. So this is important in the sense that you could have done a lot of homework behind a particular company and have read many annual reports, studied different aspects of the economy to make your decision. So there's a fair amount of planning and thinking behind the purchase. You can then see the financial statement and the company delivers profits as you expected. Sometimes companies give you guidance of their earnings, and if everything falls in place, you're spot on in terms of the earnings. You expect the share to move accordingly. But if it's an illiquid share, because it's not busy with buyers and sellers, that share price may remain flat. You may then also find a spike in the price, and as you then decide to sell, you may chase away all of the other buyers. So for that reason, to have the ease of being able to buy and sell, you want to stick with the liquid stocks. So I'll use a very, very juvenile example. If you're going to go to a nightclub, you want to go to the nightclub where there's lots of people. You don't want to go to one where the music's bad and hardly anyone's in attendance. And it's the same with the JSE. So very importantly, you want to be in a counter, in a share, where there are always buyers and sellers. I cite the top 20 companies, and I see that the slide has cut off some of the, I don't know if it's the same on that end, but if you struggle to read them, I can call them out. But these are just 20 of the largest companies. Most brokers will concentrate on the top 40, and I recommend that you look at the top 40. Many of the 20 biggest shares on the exchange have got a very big bias towards resources / commodities, but of course it's a reflection of South Africa's economy, and we're a resource-rich country. So yes, you're going to find iron ore giants, mining giants like Anglo PLC or BHP Billiton that have got exposure to platinum, to precious metals like gold, other resources like diamonds, oil, etc. But with respect to this, the set of 20 shares that are on display, you're able to keep yourself very busy. On any trading day, you're likely to see moves as much as 3 or 4% on some of these. And whilst people might think that large cap stocks, blue chip stocks, move in very small fractions, that may be true over a 1-year period. But on a daily basis, you can see quite substantial moves on these. And within the arena of single stock futures, if you talk of a move of 2%, that is actually a very rich return on your outlay. And I'll show you by way of example later on in the slides. But when you cast your eye along this, you're looking at financial giants like Old Mutual, Barclays Africa, which you still know as ABSA, companies like Remgro, which are industrial giants and hold within them many investment companies, MTN, Richemont, the luxury goods manufacturer, and so on. So it gives you a fairly big mix of the South African economy. But more importantly, it filters your outlook on the market. You only need to then watch 20 companies. You'll also find people saying, but these shares are expensive. Expensive is quite relative. So it requires a study, and companies show value from time to time and maybe overvalued. Others may talk about some of these companies requiring a large amount by way of margin. I'll explain to you what that means. And that isn't necessarily always the case. So let's go through some of the basics of what is a single stock future. I'm going to start off by giving you an example on time value of money. So if an asset's worth 100 Rand on the first day of the year, and let's assume interest rates are 6% per annum, at the end of the year, that would have grown by 6 Rand in the bank, so it should be worth 106 bucks. Or halfway through the year, it should be worth about 103 Rand. So we're all familiar with the concept. I mention this because interest rates and the understanding of this is important in terms of pricing a futures contract. And I won't be very technical about it, but I will share some of these insights. Of course, if there's any further detail, we'll always explain it on an individual basis. So let's use an example. A single stock futures contract, or for that matter, futures in general, can be thought of as a home loan. So in this example, I'd say if you are buying a R1 million house, you'd probably put down a 10% deposit. So if the property were to improve in value by 300,000 and you are able to sell it quite quickly, you could make a 300,000 Rand profit. But remember, because from your pocket, just 10% or 100,000 has been put down, you've made 300,000 on 100,000 outlay. Put differently, that's about 300%. So of course, this is the power of gearing. It's because the bank's money has been used in terms of that asset purchase. There's a flip side to this. If this house were to burn down and let's say you weren't insured and the house is revalued to be worth 800,000, there's an immediate loss, 200,000 Rand in this case. And of course, coming back to the fact that only 100K left your pocket, that translates into a 200% loss. So that's something to consider. What you're doing is buying an asset. You're responsible for that asset and any revaluation up, which is a profit. But of course, things don't always work out that way. And if it goes down, you're also responsible for that loss factor. So why would anybody even look at a levered instrument? In essence, a levered instrument is the ability to make a small outlay, that is a small amount of cash out of your pocket, to control a much larger asset. Of course, you can use it for a variety of different reasons, and there are many different trading strategies that allow you to play with these instruments to either insure a portfolio, to enhance the value of your spread of assets. But levered instruments have their place, and they are a double-edged sword, so it can be very good or bad. So I thought I must include this slide. What is a derivative? And if you think about your old textbooks, many people think of complex maths equations, and yes, the financial markets are full of equations, and doesn't necessarily have to mean you sitting there with a fountain pen trying to work all of this out. In simple terms, a derivative is an instrument that's going to get its value from some underlying asset. And of course, there's a variety of aspects to it. The price is important. Of course, there are certain rights that these assets have. If it's a share, there may be voting rights, dividend entitlement, but all of that flows on to the holder of the derivative. And I just want to stress, it does not have to be complicated. It's simple enough to explain to an average person. It's just another asset investment. It is based, in this particular example, when we talk of single stock futures, it's based on a share. And I showed you in the earlier presentation, in the earlier slide, 20 of the biggest companies in the JSE. And so a single stock future may be based on MTN. So within the JSE rules, one contract equals 100 shares. In the old days, when we had a floor in Diagonal Street, we'd trade in what was called round lots. Our clients would phone us and they would buy 100 shares or a multiple thereof. And so in these days, they've extended that rule to mean one contract. There are certain other elements about a single stock future, and so it would expire at the end of each quarter. And for the most part, single stock futures are available on the big shares on the JSE, whilst we're specifically talking large caps today. But it would be available on pretty much the top 100 shares. I mentioned briefly margining, and I think that it's important to have some understanding of what margin is. In the first example, we spoke about buying a home, using a small amount of capital as your deposit, and that gave you control of the asset. So similarly, within the financial markets, when you control a share by way of its futures contract, you put down a small amount of good faith money, which we call margin. Typically, the margin can be about 10% of what the value of the asset is. And depending on market movements, you'll find that it can be anywhere from 8% or 15%. And why would that happen? Because the JSE has set a particular Rand value as the margin, and then the share may have gone up since then. So in those terms, you're going to be outlaying slightly less. I'll put it in a different format. Because you're going to outlay 10% to control the asset, that means if the share were to go up by a small fraction, because the outlay from your pocket is only 10%, you're going to get what we talk of as gearing, 10 times gearing. But of course, it can be 12 or even higher depending on the movements that you've noticed. So let's use an example. If you're dabbling in Sasol shares and you want to buy a block of 100,000 rands worth of Sasol shares using the futures market, from your pocket you might only outlay about 9,000 rand, and you'll be in a position to control that block of 100,000. So when that share goes up in value, you make money and you are able to realize a profit. So you can understand if something's worth 100,000, Sasol's a share that trades in quite big fractions on a daily basis. You may find over 2 or 3 days it could be worth 102,000. You would have realized a 2,000 rand profit on just a 9,000 rand outlay. So I've got many examples that will give you a better understanding of that point. Now, a single stock futures contract is firstly a JSE instrument. And that's important because you're able to transact at the market price. So for any given security, for any given share, let's use Bulletin, at any point in time, there is a price that has been associated with that transaction. There's no artificial price. And so there may be other players out there that requote or put on a different artificial price. When you're dealing with a JSE product like a single stock future, there is only one price, and that's the JSE quoted price. And that gives you a lot of comfort. You're dealing with an institution that's been around for more than 100 years. It comes with a fair degree of safety and security. And so because of that, you're guaranteed that there will be payment on a day-to-day basis. When that share moves up in value, your single stock future shows you that profit immediately. And if there is a loss, unfortunately, the next day, your account will reflect that, and so you must make good by putting money in. Or, of course, you may have a balance that will take care of that loss. So there aren't any failed trades, and you've got the full protection of the JSE. And I use this picture of gears because it really is a small amount of capital that is moving a large asset. Futures contracts in our examples today, and for this discussion we're going to talk of large cap stocks, they may also be based on a commodity, they may be based on an index, and so there's a variety of different instruments that one can have over time. So let's further explain what is a single stock future. You can decide to buy a share. In our terminology, it means to go long. So if you go long and the share were to go up by, let's say, 3%, because we're using an example of you putting down 10%, that's a gearing of 10 times, the futures contract's gone up by 30%. And of course that means it's 30% on that small amount, that margin that you've outlaid. Using the futures market, you can also play a share that will fall in value. So we refer to that as going short. And a short position may also have the same sort of fractional move. So a 2% drop in the share, and you may do this because you think gold is too high, it's far too risky. The gold price may fall, and so these gold shares who are involved with, let's say, strike action may fall. And so you'll short the stock. And I'll give you an example of that later on in this presentation. But a 2% fall may show you a movement of 20% in terms of profit. So let's use a little example. If you're involved in the futures market, you're going to outlay between, in this example, 5 to 15% margin. So let's say you put out 2,000 Rand. If you are looking at an instrument that is geared between 8 to 15 times, your 2,000 Rand can show you exposure from anywhere 16 to 30,000 Rand being the range. Of course, there are some costs involved, and that would depend on the size of your account and your transaction regularity. But to just labor the point, outlaying 2,000 Rand may give you a position that will have as much as 30,000 Rand exposure. So put differently, that asset of 30,000 over a week or two may grow to 32,000. You could make a 2,000 Rand profit, let's say, over 2 weeks or a week and a half, and you've only outlaid 2,000. Appreciate also that the market can work against you, and so your loss can be as big. Just to run through some of the players involved. So if you look at this map, it gives you an understanding that us as your brokers could be buying or selling for you. You as the client, let's say, would be looking to buy a particular instrument. If you're looking to buy, we're going to act on your behalf. The place that all the action happens is at the JSE. A bank finances that transaction. But of course, you don't buy in isolation. There's going to be somebody that's a seller. So the actual asset, that 100,000 Rands worth of Sasol that we speak about, that actual asset is transacted. But there is a bank that will finance that, and this is how you are able to outlay a small amount to control that asset. Let's talk about going short. It's something that we discussed very briefly, and I used the example of a gold operator that was about to go on strike, or let's say the gold price that could be falling. The best example that I can think of is an agricultural example. If you are a farmer and you're not sure about the price of your product, you think that your sugar prices may fall in time, and so you want to protect that commodity price, you're going to sell your crop to the mill maybe a month or two before you're ready to harvest it. And so you've got a contract note from the mill to say you've got to deliver X quantity of this commodity, and you're arranged for this price. So you've sold something that doesn't really exist. You haven't harvested the sugar. That sugar could burn on the ground. It could be susceptible to crop disaster. So there's any number of things that could happen. But you have sold something that you do not actually hold. And that is an example of going short. So keeping that example in mind, you'll understand the practical nature of it now, where if you are of the view that something's going to fall, you may be in a position to take advantage of it, to speculate on it. If you hear that Pick n Pay has got some poison canned products and you want to protect yourself, you could then go short on Pick n Pay to protect the shares that you already own, or you may speculate. And by the way, this is a real example. In 2003, Pick n Pay share price fell dramatically. We saw a drop of almost 30% in the stock in a few trading days. The stock was then trading at 12 Rand, it went to 9 Rand. So that's about 25% in just a few trading sessions. And it was really because they had complaints that people were being poisoned. So there's a number of factors that affect the share price up or down. Using the ability to short, you can speculate or protect yourself. So it's sometimes very easy to go short. There's some technical aspects to it, but essentially you've got to borrow that share from someone and then sell it out into the market. Many of the top shares on the exchange are available, so you can go short on all of the top 40 shares quite easily. So in this example, I look at MTN at a price of 210 Rand. There may be a court battle that MTN's involved in, and they've just come out of one now with regards to the interconnect pricing. Let's assume that you think this is going to be a negative for the stock. So at 210, you go short. That's to say you want that share to fall. When the share arrives at 202 Rand, that's an 8 Rand move. You would have decided that's a fair movement. Let's assume you just did it on 1,000 shares or 10 contracts. So 1,000 shares, an 8 Rand move, and that's reflecting an 8,000 Rand move in your trading account. So there's all sorts of factors that are going to affect these top 20 shares. And we've given you examples earlier on that in that cluster of top 20, you're going to see MTN, Sasol, or Richemont. And so any number of factors can happen. After 2008, you saw the markets were at record highs then, and we've now gone through a full U shape. So the market dipped in 2008, and it's taken us 6 long years to climb back and past those levels. So now the newspapers and internet sites are all about record highs on the JSE. It does translate into earnings ratios, and people talk of that on a regular basis because it's an anticipation of future profits. Of course, there's other factors that are going to guide you through choosing any one of these stocks. So commodity prices might help you if it's a stock like Sasol or Billiton. Depending on whether you choose a financial stock, you might find that interest rates are going to affect you. Recently, we saw emerging markets go through turmoil, and so currencies and interest rates again became topical. So shares that trade in other markets, Richemont, for example, it's quoted in Switzerland. And so as the rand starts to look weak, Richemont immediately improves in rand terms. There may be political events. The EU, we're not certain about its future. We know that Russia is on the verge of change in the Crimea region. We know that the Arab Spring is upon us. So all of these factors and weather disasters are also going to guide these top 40 shares. So if you put in perspective what's been happening on the JSE, you're now at record highs. There's been some weakness in the market in terms of the rand. It started to strengthen. Interest rates are on the way up. We've seen one move. And at the last meeting, the Reserve Bank governor had a chance to move interest rates higher. She decided to go on hold. So many say that this may be an election type move, and because we're only a few weeks away, they're going to cool their interest rate outlook. She's given us good economic reasons for why she went flat. But she did give us also the tone that interest rates are going up. And that's a factor. It hurts financial markets. It's something that you want to keep in mind so you can go short on stocks as that comes through. Strike action has really choked the mining sector. Platinum stocks are hurt because of it. 11 weeks of no production. And we've spoken briefly about the emerging market crisis, but the rand is a focal point of trading on the exchange. It looks to foreign investors, and depending on where the rand sits, that is a reflection on whether we can get flows in and out. And of course, commodity prices, that's vital because so many of our shares are resource-based. So looking ahead, post-elections this year, depending on the outlook, it may have something to do with the budget. So some of the themes that are coming out, private schools, and you would have seen some of the education companies come to market to try and raise cash. Of course, health stocks are also important. Security-related concerns come in. It's a sort of spending that government would do, and that's the sort of drum that they're going to beat around election time. There are issues with regards to wages, poverty-related issues, and so that affects strike action. The other aspects, and this is important from a South African point of view, we're an emerging market. So quantitative easing, which really meant the US government putting cash into financial markets to keep them flowing, that money is now going to dry up. So we've got to find other source of capital. And that's important from a South African point of view as an emerging market to keep the wheels of the economy rolling. This market needs to find capital. So we're competing with other emerging markets for cash. Interest rates are still important. And of course, looking ahead, commodity prices are going to change. Food prices are on the up, and that's really because grain prices are high and energy prices have been challenging. So when would you be trading a single stock futures? There's a few different ways that you can approach this. I'm listing 3 important topics. So the most common place that we find today is speculating. People think the prices are going to go up or down. Simply put, you'd look at a company like Bidvest, and for whatever reason, you think this is an industrial giant. it reflects the South African economy. If interest rates are going to go down, if the price of goods and services have changed and so inflation's affected, for whatever reason you think Bidvest is going to be the bellwether. And so you'll play it depending on your perspective, up or down. Many of the sophisticated financial players would be looking to protect assets, will be looking to put on a variety of strategies. And so they may be hedging. Hedging is just another way of saying we're taking an insurance of some sort. We hold lots of commodity shares. We hold Sasol, Billiton, etc. And if commodity prices were to move, these shares are going to fall in value. So we'll put in place some protection when the JSE is high, as it is now, every day breaking record highs. Arbitrage is something that players use to take advantage of market moves. There are a variety of different ways to get involved in it. It is quite a sophisticated approach. Many people write very detailed programs that give them an edge in terms of movements, in terms of prices, and so they can make almost without risk profit by playing between two markets. So a good example is something like Richemont. You probably already know them, the luxury goods manufacturer. They've got all of the watches and pens and other luxury items. That stock trades in Switzerland as their primary home. It's listed on the JSE, and there may be a difference in the price, and so players may look to take advantage of the two prices between the two countries. So, the most important trading tool ever. So this isn't a secret. All of you already know about it. But I stress that this is the most important trading tool ever. Very experienced brokers, people that have been doing their trades for so many years, sometimes lose sight of this. And this, for me, is the most important trading tool, the stop loss. Because if you're entering a transaction, at the back of your mind, you have to cater for that instance where the market doesn't favor you. And that's what we refer to as a stop loss. So there's a few elements that go with it. Firstly, the stop loss is a prearranged exit plan, and really that means you're going to write out a number that you will exit if the market doesn't favor you. You must be very strict about your stop loss. So there's times where it touches your level and you think it's just going to be going up from this point. So I don't have to stop loss. And unfortunately, markets sometimes tease you and they touch your level, you stop loss, you get out of your position, and then it starts to rise again. That's unfortunate, but a stop loss is vital. So if it hits your level, you've got to exit. So what is a stop loss? For those of you that are not really familiar with it, it's an order that you're going to place either on your screen, or you're going to phone the broker and you say, what's the stop loss for me? Please get out. Most of the clients have got online trading platforms, so they're able to put in their own levels. But that's really to say you want to protect yourself if the market falls against you. Okay, so for large cap stocks, and this is the reason that I favor them, a variety of different analysis can be done on the financial markets. Fundamental analysis happens to be studies of their income statement or their balance sheet. It may speak to the broader aspects within that sector. Technical analysis is a study on charts. There's a lot of detailed study that can go on, and this gives you very good trading direction. It helps you in terms of entry and exit levels. There are many different strategies that you can apply. People talk of algorithms. This is just a fancy set of computer programs that will help you and show you entry and exit points. And of course, as I mentioned, the stop loss. But for all of these, and for many different types of strategies that people use, it works well if you're dealing with a liquid instrument. So it works well if you're dealing with a share that trades in billions, something like Billiton, which trades probably £1 billion or more on a daily basis, which means you can enter and exit the share 100 times in a day if your trading strategy allows you and your costing allows you. But that is the sort of stocks you want to be playing with. So if a stop loss is hit, you can get out immediately. It's the most painful thing to see a stop loss reached, and when you look at the market, the level of buying and selling action is such that you can't even exit. And then you would be forced to exit at a much lower level, and that goes to liquidity. Technical analysis is such an important trading tool, but it only becomes valuable if there is sufficient data on that chart. If a stock doesn't trade, you might have looked at a chart of a share and it looks like a building block. It's just rectangular blocks. You can't do a very valuable technical analysis study on such a chart. So you want regular flows of data to help you with technical analysis. And of course, fundamental analysis. This goes to the dissemination of financial information that help you analyze it. For these large companies, they spend a lot of time and effort to make sure that information is available to the public on time, in an easy, readable format. Everyone has the internet today, even on their phone. You can go and have a look at a balance sheet of Anglo American. And the difference is, because these companies are large, there's so much of scrutiny. There's regulators like the Johannesburg Stock Exchange or the Financial Services Board constantly watching them, watching the transactions that go on. There are many analysts talking about them. You get a fair picture of the share price. And I'll give you an example of a company that's been in the news recently, Pinnacle. You would have seen some unusual transaction activity. You would have seen that share price tumble by about 40% in 2 trading days. And I know that the authorities are looking into it, but it's surprises like that that are unlikely to happen with large cap stocks because there's so many eyes watching it. Some of the other types of strategies you're going to be looking at. Firstly, single stock futures by its very nature gives you the ability to unlock some of your capital. So you will be in a position to let a R1 million portfolio be replicated by something like 100,000 Rand. And that gives you a fair amount of comfort in that if the market provides further opportunities, your capital is available to tap into other sectors or some of the companies that you already own and you want further exposure to. There's, excuse me, I've placed registers on the various tables, so if you can please fill in your details. If those of you that have come through a little late, if you can let us have your name, number, and your email info. To further explain the strategies on the large caps, pair trading is by far one of the most often used strategies. So for those of you that are not familiar with the concept of pair trading, I'll be doing a presentation on that at least twice over the next few months. But simply put, with pair trading, you look at 2 different instruments and you want one instrument to go up and one instrument to go down. So on the face of it, that might seem bizarre. Why would anybody want to do that? So there's a lot of wisdom in this strategy. If you think of 2 companies, and these are businesses closely linked to each other, MTN and Vodacom, both operate within the telecommunications space. Both are expanding within different sectors of technology, be it data, be it the sale of hardware. But you may find that for whatever reason you favor MTN. It's got an Africa footprint. Vodacom's only South Africa. Or maybe MTN is going to be coming out with innovative product, or whatever the reason is. But you're not confident enough about the market. So we're at this point where the JSE is at a record high. You want to be involved, you want to take full advantage of the market, but you don't want to have 100,000 outlaid on MTN and that's your only position. Because if the market were to crash, so if you had a pair trade though, you'd go long on MTN. Remember I spoke about shorting the market. You'd go short on Vodacom. So what that would do is it'll create a balance. But your research tells you MTN's a better company. So when both go up, MTN should go up more than Vodacom. If the market falls, both fall. But remember, because you've shorted Vodacom, you'll make money on that one, probably lose money on MTN. And so you balance yourself. But you're really waiting for that day when MTN shoots up because its company results are good or whatever the reason is, and Vodacom just travels along. And so you'd make that little profit there. Of course, single stock futures are very cost effective. When you dabble with the actual share, and so many years ago, that's what we did. We bought and sold the actual share. There's a variety of securities taxes involved. There are a variety of brokerage fees, VAT, and so the list goes on. And you'll find even though some discount brokers advertise reasonable rates, when you start adding on the layers of charges, you'll find that single stock futures as compared to share dealing becomes a lot more attractive. Of course, there are tax implications. If you make money dabbling in single stock futures, then you're subject to income tax in terms of the rules. And this is probably a vital reason. We did say that many people use single stock futures as a speculative tool. And so for day trading, buying and selling in a quick time frame, single stock futures provide you with that solution. The costs are so effective that you can be in and out within a few hours. And of course, because you now have the ability to short without any complicated rules, so you can protect yourself if you think markets are going down. Ladies and gentlemen, I want to say thank you very much for joining us. I hope this gave you some small insight to trading large cap stocks. I know that you will have many questions, and I hope to be able to answer them. I urge you to fill out your email details, and I hope your writing is neat, because tomorrow morning I'm going to email this presentation pack to you so that you'll be given an opportunity to look over it, and I'm sure you will be probably sitting with even more questions then, so you're welcome to contact me. When I email you, you'll have all of my details, but I put some of it on the slide. But I open the floor to questions. Share price, the risk associated with the movement of their share price. And so it varies from day to day. I think my friend from the JSE is going to give you a very good explanation, so I'm going to let you enhance on that.